Markets and invite Mukul Kochhar from Investec Capital Services here with us on the show now. Mukul, morning. This is Reema here. So let's start with your overall read on the markets in terms of macros, the global positioning in India, and even the market outlook.
Sure. Thanks, Reema, for the invite. So, Reema, what seems to be very critical for India at this point is aligning consumption. There is a lot of money in the economy that can be invested. The private sector is flush with capital. It's completely delevered. It's demand that needs to be stimulated. Now, that was on cards, as we were set to sign a treaty with the US, which is a 6 times consumption market than the US. There was also a desire to restructure supply chains to diversify away from China. So all that was actually set to play out, and we were expecting a substantial amount of private investment to come into the economy to give a boost. We believe that has been delayed, and it's a complicated issue and it's going to take time to play out. But eventually, the long-term, the long-term logic of this trade treaty still remains. US needs to align with, or US needs India to align with itself in the long term. If we tilt towards China, that is not beneficial for US in the long term. Near term, we don't seem to have cards, but long-term cards are very strong. So we expect the trade treaty to go through, and that will be a trigger for private investment and for the market to move. In the meantime, the trade pressure is real. It is exerting pressure on the INR, and that is why the range-bound markets in the near term. Last point, EU is an equally large trading partner, and we seem to be making progress over there. Opening up of that a large economy for Indian goods is also going to be a positive, but EU just moves slowly. Yeah. So if we do sign the trade treaty with the EU this year, it has to still be ratified by all the different, countries, 27 different countries, which takes time. So EU, even if we get it done, it's a year and a half before we can expect some economic impact. So we're closely watching the US-India trade deal for the next move for markets.
Indeed. But Mukul, TCS came out with numbers yesterday. What do you make of that? Not specifically towards TCS, but do you believe that the rest of the IT pack will follow suit in terms of the kind of announcements that it has made, be it the data center foray or stating the fact that they are going to be more aggressive in terms of making acquisitions? Is this IT's time to rebound, considering, or if you could say, the proverbial backs against the wall kind of a scenario?
Yeah, absolutely. So IT, we should recognize that IT sector in India is a trading sector, especially the large caps. Yeah, this is no longer a secular growth sector. It's fairly large. We have substantially large market share of the offshore market. So we do we are exposed to global investment cycles. Yeah, IT investment cycle. In that manner, the sector has underperformed for some time, both in terms of earnings growth, sales growth, and stock performance. We believe the stocks sector is set for a rebound, but once again, we emphasize it's a trade. The catalyst for the rebound will, of course, be good demand commentary from the companies, and not to forget that the INR has depreciated, which is both a benefit for INR top line as well as margin. So yes, we've been asking investors to be constructive here, look for a trade in that sector.
What were your thoughts when TCS announced that investment, 1 gigawatt data center capacity?
It's interesting, yeah. So I used to cover the sector 20 years ago in the US, and companies were exceptionally tight-fisted with capital allocation, and that is what used to account for exceptionally high multiples at that time. But remember, this was a 25-30% growth sector as well. So I think that capital allocation discipline, it will still be disciplined, but you will see some sort of loosening of the strings there. Indian IT companies were always averse to M&A because IT services integration is notoriously tough. But as growth comes down, size picks up, they have excess capital, you will see return dilutive investments take place, not NPV dilutive, but return dilutive. So I'm not surprised. It's a function of the time.
And should that be read positively?
You know, you can take it as it is. ROIC will come down for the sector. It will derate a bit, but as I said, it will be NPV positive. It also needs to be done. Yeah. So we need to create data centers for servicing Indian data. So yes, it's an NPV positive sector. So I would probably think it's a positive overall.
What do you make of the slew of banking updates that came out earlier this month, Mukul? At least from most of the lenders that came out, we saw double-digit growth in the advances and the deposit front as well. What are you watching out for when it comes to banks this time around, considering the fact that the loan growth and the deposit growth parameters have been taken care of this time?
Yeah, so banking sector we've been actually constructive on and tied to the US move. Some of the pressure in the banking sector was coming from expected NIM pressure as the street was expecting RBI to cut rates. Till we have a belief that till we sort out our trade deal with the US, RBI will be reluctant to cut because that exposes the rupee. We've been hearing recently that RBI has also been intervening in the money market. So if you're intervening in the money market to protect the rupee, then rate cuts are probably off the cards, is what I feel. In which case, you will see margin upgrades in these sectors, and part of that is already playing out, and that's why the sector becomes attractive, especially the PSU bank, play where there was as a percentage the EPS impact from rate cuts was supposed to be the highest. There's also the fact that there's a pickup in lending post some government stimulus. There's also the fact that asset quality seems to be getting better.
Thanks, Mukul, for joining in. Short conversation today, but a great one nonetheless. Thank you for joining in. Get into a break. We'll come back with more on the markets.